Welcome to The Explainer. Today, we're diving into a really critical part of the tax code, one that can genuinely save businesses a whole lot of money. We're talking about Section 84 of the Income Tax Act, 2025. You can think of it as a lifeline for industrial businesses when the government compulsorily acquires their assets.
Okay, let's just jump right into a scenario you might actually face. Imagine your client's factory land is taken over for a new highway. They get a huge compensation check, but then they see the massive capital gains tax bill. It could literally stop them from ever rebuilding. So, what do? Well, the good news is Section 84 gives us a clear path forward.
So here's how we're going to tackle this. We'll start with an introduction to Section 84 itself. Then we'll get into the nitty-gritty of the exemption. We'll walk through a practical example, cover the compliance side, talk about some common challenges, and then we'll wrap it all up with the key takeaways.
Right. So it's really important to know that the Income Tax Act 2025 actually plans for situations like this. It doesn't just leave taxpayers high and dry. Section 84 is that specific legal safeguard that's built in to provide relief.
Now, for those of you who've been in the field for a while, this might sound familiar. You're probably thinking of Section 54D from the old 1961 Act, and you'd be right. Section 84 is basically its successor. It carries forward that same core idea of exempting gains as long as you reinvest them.
So, what's the government's thinking here? Well, the intent of the law is really clear. It's not about punishing a business for a gain they didn't ask for. I mean, the acquisition was involuntary. The real goal is to help that business get back on its feet and to encourage them to reestablish their industrial operations.
Okay, now let's get into the mechanics of it. How do you actually claim this benefit? Well, it's not automatic. You have to meet a very specific set of conditions to even be eligible.
Think of it as a 4-point checklist. First, it has to be a compulsory acquisition under the law. Second, the asset itself, the land or building, must have been part of an industrial undertaking. Third, you must have used it for that business for at least 2 years right before it was acquired. And finally, the big one, you have to reinvest by buying or building a new asset within 3 years.
Now that term, industrial undertaking, is super important. It acts like a gatekeeper for this whole exemption. The law is specific. It means a business involved in manufacturing, processing, mining, or power generation. So if your asset was just used for trading or some other commercial activity, it's not going to qualify. The whole idea is to protect the country's productive manufacturing base, not just any commercial business.
All right, enough with the theory. Let's crunch some numbers and see how this actually works in practice. A real-world example will show you the kind of financial impact we're talking about.
Okay, so let's start with our case study. A company's factory land gets compulsorily acquired, and the government pays them 5 crore rupees in compensation.
Now we have to figure out the cost. After we adjust for inflation over the years they held the land, the index cost comes out to 2 crore rupees.
The math here is pretty simple, right? 5 crores compensation minus the 2 crore index cost gives us a capital gain of 3 crore rupees, and that's the amount that would normally be taxed.
And this is where it gets really interesting. Let's look at 2 possibilities. In scenario 1, the company reinvests 3.5 crores, which is more than the 3 crore gain. The result? The entire 3 crore gain is exempt, 0 tax on it. But look at scenario 2. Here, they only reinvest 2 crores. Since that's less than the capital gain, only 2 crores are exempt, and they still have to pay tax on that remaining 1 crore.
So meeting the conditions is just one part of the puzzle. To actually get the exemption, you have to get the procedures right. Let's break down the timelines and the paperwork you'll need. This is where people often trip up.
Okay, this next point is absolutely critical, so listen closely. When does that 3-year clock for reinvestment start ticking? It's not from the date the land was acquired. The law is very clear. The countdown begins from the date the compensation is actually received, and that's a huge deal, especially if there are delays in government payments.
As with anything in tax, your best friend is documentation. You need a solid paper trail. That means the government's acquisition notice, bank statements showing when you got the money, the purchase deed for the new asset, and records proving both the old and new assets were used for an industrial undertaking. A clean paper trail is simply non-negotiable.
All right, so the law gives us a framework, but we all know the real world can be a bit messy. So let's talk about some of the common practical questions and tricky scenarios that pop up when you're dealing with Section 84.
Here's a question I get all the time. What about a lock-in period for the new asset? I mean, can you just buy a new factory and then sell it a year later? You have to understand that this tax benefit isn't permanent from day one. If you sell too early, the exemption can be taken away.
So here's how that works. Section 84 has what's called a clawback provision. If you sell that new asset within 3 years, the capital gain that you got exempted earlier suddenly becomes taxable income in the year you sell. The whole point of this lock-in is to make sure you're genuinely reestablishing your business, not just using it as a temporary tax shelter. You have to hold it for 3 years to lock in the benefit for good.
Okay, here's another very real-world situation. The government doesn't always pay the full compensation in one lump sum. So what happens to your reinvestment timeline if the money comes in dribs and drabs?
The logic here is actually pretty consistent. The rule about tying the timeline to when you receive the money still applies. So each installment you receive essentially triggers its own separate 3-year reinvestment window for that chunk of money. This gives you some flexibility, but it also means you have to be super careful about tracking multiple deadlines.
We've definitely covered a lot of ground. So just to make sure the most important stuff really sticks, let's do a quick-fire summary of the main points from this explainer.
Okay, here are the 5 things you absolutely have to remember. 1. Section 84 is a relief measure. 2. Reinvestment is the absolute key. 3. The 3-year clock starts when you get the money, not before. 4. There's a 3-year lock-in on the new asset. And 5. This only applies to industrial undertakings.
Look, at the end of the day, Section 84 is a powerful shield. It can protect a business from a huge tax hit and help it recover and grow. But you can only use that shield if you follow the rules, the deadlines, and conditions with absolute precision.
We hope this explainer on Section 84 was clear and helpful. Thank you so much for watching. And hey, if you found this useful, please do like, subscribe, and share it.
And just a quick reminder, as always, this is for educational purposes. Tax laws are complicated and they change, so please, always consult with a qualified professional for advice that's tailored to your specific situation.